A lot of traders are not profitable today because they do not have a very simple plan to do that, because they usually mark every point of their chart and they just trade from any place, right? And which is the wrong thing to do, right? So in this video, I'll try to make it short as possible. I'll try to dilute everything to show you the most or the simplest way to be or form to become profitable, right? So firstly, the first thing we will talk about is market structure, right? And also time frame alignment will follow it. So first and first, market structure, right? So if people think market structure is just all about higher highs and higher lows and lower highs and lower lows. No, leave that or leave those for beginners, right? Beginners are not yet talking about profitability, right? So you must get to an extent before you start talking about profitability. So leave that to them. Now, many traders just believe they must trade from every zone or every other block or every FVG is good to be traded from. No, I want you to I want you to just pick up just one thing from this video. If it's just this one thing, I'll be fine. Right. So the most important thing for you to pick out is this: that market structure, or the best way to trade a market, is basically something like this. When you see markets going like this, right? This zone, hold on. This zone, you should never trade from this zone. It's wrong to trade from that zone, right? But these are the zones you should trade from. You see this zone, because this zone broke structure, right? This zone, because this zone is the precursor to this break here, right? It broke the structure. You can also trade from this zone. This zone is a no-no. Don't trade from that zone because it did not break any structure, right? You can trade from this zone. If market comes back here, this is a good zone to trade from, right? You can trade from that zone. Oh no, don't mistake. Don't trade from that zone. Although it is a good place to take trades, because I think it's a good place to trade from, because it is the precursor to this whole move, right? So, and it's in fact the apex area. So this is a good place to trade from. But don't trade from here. Don't. This is a good place to trade from, because why? It broke this structure. It broke this area, right? This one as well. Why? It broke here, right? This is the only thing you need to take from market structure. You don't need all those lower highs, lower lows, trading from every other block. No, you just look at where did market break structure. Then you take that zone. That's all you need. You don't need to trade from every fair value gap, right? That's the first thing. So know where to trade from, which is mostly the origin of breaks. That's what you need, right? Second, let's move. Time frame alignment, right? I used I used something I call, or actually people call it HTF, right? HTF is higher time frame. HTF is higher time frame basically. So HTF, there's MTF, then there's LTF, right? The higher time frame could be 1 week, right? 1 day, H4, right? Then the mid time frame could be 1 day, H4, M30 or H1. Let's say H1 or M30. Then LTF could be, for this one, could be H4. Then this could be M15. Then this could be M5. Right. Now, why did I do these things? The H4 is used to determine direction only. You only need to go to the higher time frame actually to determine the direction of the market. Right? Swing traders, this particular area is probably just for swing traders. I don't use it because I'm a day trader, right? When you are a swing trader, you open your charts probably to the 1 week time frame, right? Then you look at the direction. Then the 1 day or the daily chart time frame, which is your mid time frame, will be used to determine your POIs, like you say, or your zones, right? That is the important areas you want to see market trade into before you take your trade, right? Then the lower time frame, these are the zones where you take your entries from, right? The 1 day as well, your 1 day would be the yes, your 1 day, which is the HTF, then you have your MTF as the H4, then your LTF as the M15. If H4 is your HCF, that is your higher time frame, know that your MTF will be your H1 or M30, then your entry will be at the M5, right? This is basic market um this is basically market time frame alignment, right? Then the next thing we need to figure out is the key levels that we want to trade from. So key levels are one of the key levels coming as this MTF, um which is your middle time frame, right? That is where we start using our MTF. Okay, that is where are the important zones we want to buy or sell from. That is when we start asking questions, and um these are the kind of key levels we are interested in. Firstly, A level looks something like this. V shape look like this, right? Now A level is formed when you have a bullish candle, right? And a bullish candle close, then a bearish candle open. This is your A level, right? Don't worry, we will go to the line chart and we will see more on this, right? Then your V level is formed when you have a bearish candle close, when you have a bearish candle close, uh-oh, a bearish candle close, right? Then you have a bullish candle open. If you don't understand this, let me use OHLC or candle closures. Let me show you. Let's say this is a bullish candle, right? You have your wicks here, right? This is the um candle high, right? This is the highest place, right? This candle traded up to, right? This area is the close, right? This is the open, right? Then this is your low. Because why? This is the lowest point that the market traded to, correct? High, close, open, and low. And if you watch here, I said it. Know that this area is your close, and that is where you should mark as your key level. Don't worry, sometimes you will see that this bearish candle might actually in fact jump to this particular area. It does something like this. Hold on. It does something like this. You see something that happens in this way. You see something like this, right? Then have a bearish candle doing something like this. You should not mark it from this area. No, don't do that. This is where you mark it from, because this is where you are interested in, because that is the close of the bullish candle, and that's what forms your A level. Correct? Good. Now we have something we call OCLs. Right? OCLs are interesting, and points to be taken. We don't mark OCLs in MTF or LTF. That is your middle time frame or your lower time frame. You don't mark OCLs from that point because they are usually not very strong from that point, right? You mark OCLs only from the higher time frame, which could be daily or weekly. I seldom mark OCLs on H4 time frame. In fact, I don't trust it enough. I only trust OCLs on the daily and weekly, and then probably monthly upward, right? That is what I trust when it comes to OCLs. Now, how do OCLs form? Let's form a bullish OCL, right? A bullish OCL looks something like this. You will see a bullish candle, right? Then you will see another bullish candle, right? The midpoint is the OCL, and the midpoint must be the close of the first candle, right? This is the OCL, right? If you see something like this, no, if you see something like this is not an OCL, sorry, because an OCL must be of the same of candles moving in the same direction, right? Moving in the same direction. If it's going bullish, it must be two bullish candles and not one bullish, one bearish. No, it must not happen like that, right? And also here is a bearish OCL, right? This is you have something like this, you have something like this, you have something like this. This area, that's the close of this first candle, is the OCL, right? We can also trade from this point, but again, I say you don't trade OCL from your middle time frame or from your lower time frame. You only trade them from the higher time frame, right? Exactly. That's how we treat them. We will see more when we get into the chart because that's where I will bring everything together, right? Now let's talk about candle closure. Candle closure is also very important in this journey, right? Let's talk about candle closure because how candle closes is very important to how we trade MSNR. Okay, so many a times I see people they lose money because they are not patient enough for the trades to come to them. They just want to get in on the trade, right? And which is a bad way to trade, which is very, very wrong to trade, right? So this is the candle closure I'm talking about. For us to take a trade, we must have something like this. There must be something that happens like this, right? Or something like this, right? Which is basically that there must be a sweep of liquidity, right? There must be a sweep of liquidity. SMC traders call it they call it either engineered liquidity or they call it inducement, right? It's the same thing, just liquidity. You just want to see a sweep, right? The sweep could be something like this. You see this particular zone, if you see market do something like this, right? It has swept this particular region, right? Then the next thing you expect is that market will go to the other direction, right? Now, when you see that move happens, right? When you see that sweep happen, that is when you want to go into the market. And how do we identify sweeps? We say sweep, sweep, sweep. How exactly do we identify sweep? We identify sweep by looking at key levels. Firstly, if we see a support like this, and we see markets come do something like this, right? And come down here with a wick, right? This is what we call a rejection. This is what we call a rejection. Do the same, switch the same thing vice versa to the upside. We just want to see rejections. Now, a rejection can happen at an A level, a V level, an SBR, an RBS, or a QM. You'd say, oh, what is an RBS? What is a QM? An RBS or a QM are failed. Yeah, firstly, let's do RBS rather. So RBS is basically resistance broken and turned into support, right? Resistance broken and turned into support. Now, this is what a typical RBS will look like, right? This is an RBS because why? This is a resistance. Now, it has been broken through and turns into a support that will help the market continue its momentum to the upside. This is an SBR, which is something like this, right? This was a support. It got broken through. This is the support. It got broken through, came back again, was tested, and helped the market to continue in its downward trajectory, right? This is what we call SBR and RBS. Now, the last one is a QM. QM for me, in many cases, I usually don't use SBRs and RBS. In many cases, I don't use them. I prefer using a QM. QM is basically what we call Quasimodo reversal patterns, right? Now, how does a QM forms? A QM is basically a broken support in two places or a broken resistance in two places. This is what I mean. We have something like this, right? This is a QM. Why? Because it has been broken through first time, right? Broken through again second time. What happens? The market comes back there again, respects it. Now it is not getting broken through. It's respected, right? And used to what? To continue a rally to the upside. Same thing can be done too in a reversal, right? A QM, I prefer, in many cases, I prefer trading from a QM over RBS and SBR. For me, that's it for me, right? Because QMs are, I've seen that they are mostly stronger to use, right? So these are the things, these are the key levels we will be using in this particular video lesson, right? And also the candle closure importance, right? So let's switch over to the chart and we can now continue with the entries, target, and stop loss. But firstly, let's go to the chart and make a quick analysis. So this here is the section where I'll be talking about the chart, right? So firstly, if you watch closely, this market is trending to the upside. That is it is bullish, right? Because it has been breaking structure to the upside, right? Making new highs, right? So it is very important that we are aligned, right? So the market, firstly, all we just want in this higher time frame, because this is the daily time frame I'm using, right? It is quite bullish, right? Now that's all I need from here. Then we will have to switch to the 4 hours chart, because that's where we look for our POIs, or that is point of interest, or our zones of interest, right? Now, if you come here, you would notice something. I want to use the GBP JPY chart here. You'd see something. Let me use this area. Okay. So this region broke structure. That is this particular region. This low, right? this low here. Oh, what's going on? This low that I will be marking here, right? This is broke this structure at this region. It broke this structure here, right? It broke it, right? Now, when it broke it, it came back. Now, if you watch this area, this is the area we should not trade from. Anything from here is what we should avoid. We should not trade from here. Why? Because it did not break any structure, right? It did not break structure, right? So that's the thing. It did not break structure. Now, this one, we can trade from this one somewhat because it broke the structure. But it is a minor structure it broke. Like it wasn't a real major movie. It broke off, right? Now, what happened to the market after all these breaks? If you watch well, the market came back down, haunted the stop loss in this two areas, right? Then came back to look for a point of interest, like people will say, or a zone of interest. I prefer using a zone of interest because the market might not actually get to the particular key level you are looking for, but it will get to somewhere close sometimes to that particular key level you are looking for. And it is another key level again, close to your key level. That is what it will uh use, right, to continue its rally. Okay, so let me mark out the line uh that was taken, right? So this area, what's going on? So get out. So this area was used, right, to continue its upward movement, right? So that's actually an SBR that was used, right? The market did not come to this V level. He used this SBR, right, to continue its movement upward, right? So let me go to a current market so that I can also show you entries and stop losses, right? How to place them. Okay. So market is still moving. This is today is a Monday. I'm making this video on a Monday, right? So let's take a look at something that happened a few days ago. If you watch here, market liquidated this low, right? Market took it out, right? It took it out, and also some other lows, right? That I wanna be viewing right now. So what happened after market took out those lows? This is the mid time frame. Remember, now when did this happen? This happened by on Wednesday, May 6th, and this candle closed at 6 a.m. because this is 2 a.m. resumption to 6 a.m. close, right? So I'll go to that time frame, that is 6th May at 6 a.m. I'll switch to my lower time frame, which is the 15-minute time frame, and that is where we will take the trade from, right? So yeah, so I'll show you how I'll take an entry and how I'll set the stop loss. So this is we are getting to Tuesday, right? Tuesday 6 a.m. Now this is 5:45, and that's the candle, right? Now what happened? What happened there? If you watch here, this is a low. In fact, this is a very simple. This is the easiest trade that you can take, right? All you need to do is wait for either an engulfing to form, or you wait for a V level, that is the order block, like people will say, to be liquidated. That's all you need, right? That's all you need. See, let's take a sample. If you watch here, The market actually used that area. Oh no, I marked rubbish. So the market actually came to that point, right, to liquidate that particular low. That's what happened. Then we will set the entry from that particular point. Immediately the market liquidated from there, we will set the entry from that spot. Let me take this out. That was a mistake. Okay, so set it here. Then the stop loss will just be probably keep it at the middle of this long week because sometimes markets will retest, right? Then I'll target the opposing key level, right? Let's switch to the 4-hour time frame, and that's the key level I'll be targeting. Okay, so where's the key level? This is March. I'm looking for, we are going to May. Good. Now, if you watch, this is the key level that caused um that liquidation, right? And it is only proper that we target that same key level. So I'll just place the target at that key level. Sometimes markets will just get there and liquidate and continue a downward move, and sometimes it will break past and continue, but at least that is where we are targeting. It's that simple. You don't need to stress it, right? This is all you need to become profitable. You either look for an engulfing candle and trade from it, or you look for market to sweep, right, a V level if you are trading a bullish trend, and also you do the same for the opposite. If you are trading for a downtrend, that's a bearish market, you look for the A level to trade from, or also an engulfing candle. That's all you need, right? So yeah,